Hello, everybody. This is Steve Cassaday, Chairman and Chief Executive of Cassaday & Company, with an update on the markets as of May 1st, 2020. As you can see, I'm still here in Naples, Florida, and as you can also no doubt see, I'm in desperate need of a haircut, as I'm sure is the case for many of you listening to this video. As March was one of the worst months in history for stocks, April has been one of the best. After a blood-curdling 12% price decline in March, the S&P rallied to a 12.8% gain in April, again supporting our assertion that remaining fully invested and broadly diversified, although imperfect, is the most nearly perfect option for long-term investors. Our models have performed as expected during this volatile time, but remember, since they are diversified across asset classes with a mix of risk assets and more secure choices such as bonds, they should go down less than the broad market and should also be expected to go up less than the broad market when it rallies. As you can see, the average return for Cassaday & Company models as of April 30th for the year to date is a negative 9.8% return, which considering the environment that we're in is actually pretty darn good. The market has had the best month since 1987, and yet we have major measures of economic activity showing horrific readings. What the heck? But let's look at why this isn't as crazy as it might seem. Number one, markets go to extremes in both directions. March's decline was an example of this. The rally is a correction of a market that may have overreacted based on uncertainty of outcomes. These extremes are often opportunities to make portfolio changes. We have taken advantage of conditions over the last few months to take tax losses, rebalance from bonds to stocks, and upgrade your portfolios to investments we believe were mispriced during the panic selling and may represent outstanding opportunities looking forward. Number two, markets are forward-looking. They anticipate future events and react in advance. The S&P was down over 33% before we had lost 30 million jobs and had a nearly 5% GDP drop. Now the reverse is happening. Markets are anticipating a recovery, and we think rightfully so. Number three, what about the risks and dangers to this potential recovery? We are in the midst of an unprecedented economic downturn and are clearly headed for a recession, which is 2 quarters of negative growth in a row. In addition to the first quarter GDP decline of 4.8%, we are likely to see a Q2 decline in the mid-teens, which will be the worst since the Great Depression. As with all economic forecasts, these are guesses, as GDP is revised every quarter and estimates for the Q2 numbers for GDP and other indicators vary wildly depending on the source. But few will argue that the decline in economic activity will be steep. We believe that the markets will be jittery as these guesses about scary outcomes actually take shape and become real. We need, however, to be prepared for the possibility of continued volatility as the daily headlines are unlikely to include good news, although there is quite a bit out there. As markets do decline, we will take advantage of the situations as appropriate. So one of the big questions in here is, number 4, are stocks overpriced in light of all these potential negatives? Although we have had a nice rally in the S&P 500, this is due to the large weighting of communications, tech, and healthcare stocks, which represent 45% of the index. For 2020, through Friday, May 1st, the S&P is down 12.41%, but communications, technology, and healthcare sectors are down just 4%. The remaining sectors in the S&P are down an average of 21.3%. Although this does not preclude market declines from these levels, the major indexes are not accurately reflecting the depressed valuations of many of their component companies, which are priced for pretty bad outcomes. Number 5, small and medium-sized companies have suffered much greater declines than their large brethren and are also reflecting a very bad outcome. As you can see from this graph, the S&P is down 12.14%, but mid-sized companies are down 23% and small companies are down 27% during the same time period. Despite seemingly irrational performance of the major indexes, when we look at the internals of the overall markets, we can see that the vast majority of stocks are still way down and reflect the tremendous uncertainty that now exists. Also unprecedented is the level of government stimulus that has been applied worldwide. In the United States, the Fed and the Treasury have literally carpet-bombed the economy with money and provided liquidity and backstops to protect the credit markets and the financial system. They have and will continue to work together to do whatever it takes to get through this difficult time. The amount of money involved is sufficient in our view to bridge the gap and keep the economy afloat until it is able to recover on its own. But the duration of the lockdown is a key element. If we continue to shut down economic activity at the current level, the global impact will be disastrous. Another stimulus is likely, but again, an ongoing shutdown cannot be sustained for more than a few months at most if we want to avoid economic collapse. It is clear that the policymakers know this and are working hard to find the balance necessary to keep people safe, make the populace feel comfortable about the risks of the virus, and reopen the economy as quickly and responsibly as possible. Not all parts of the economy are in trouble. There are opportunities everywhere. New and different approaches to commerce are already showing up, and American innovation, ingenuity, and imagination will, as they have in the past, bring a new world that we believe will be better, more prosperous, and better prepared for the future. As your advisors, we are positioning your portfolios to potentially take advantage of this situation that we see looking forward. Remember, people will get up every day, put their pants on, go to work, and strive to be productive in order to survive and to succeed. It's human nature. Okay, maybe they'll put on their pajama pants or their yoga pants, but you get the idea. We think that from this point forward, gradually lifting policies that are constraining the economy and a concomitant change in consumer attitudes towards virus-related risks should lead to an eventual economic rebound, and we think it could be very robust. Although slow at first, and not including all sectors, it is possible that a recovery will take the markets back to the highs and beyond. What if it takes a long time for this to happen? Here are the returns, assuming various times for recovery back to the February peak. The all-time high on the S&P 500 was reached on February 19, 2020 at 3,383.4. The close as of Friday, May 1st, 2020 was 2,827, which is a drop from the peak of about 555 points. As you can see below, if it takes half a year for us to get back to the 3,383 peak, that's a return of almost 20% from current levels. Same is true if it takes 1 year. If it takes a year and a half, the annualized returns back to the peak would be 12.72%. If it takes 2 years, the returns would be nearly 10%. 2.5 years, the returns would be 7.45 annualized. And if it takes 3 years, a very much of a long shot in our view, then your annualized rate of return would be 6.17%. Although there is risk that this won't happen, these returns are reasonable given that the safe alternatives returns are near zero. If you don't need all of your money at any given time, which you will not, leave it alone, let it percolate, and wait for the markets to recover. Again, the most important component of a market recovery is helping people to feel more secure about their safety. Headlines that go in the other direction, accurate or otherwise, will have an impact on the prices of risk assets, and this will be seen as a threat to restarting the economy. In the final analysis, this is all related to the virus. If we can get to equilibrium between a cessation of shelter-in-place and social distancing protocols and managing the instances of infections, deaths, and the accompanying stress on the healthcare system, we should be able to gradually open the economy back up, and I believe in relatively short order. In conclusion, the parts of the economy that require large gatherings, face-to-face interactions, and close personal contact for successful execution of their business models will be the most affected, with dramatic changes in how they operate. This will affect earnings, employment, and capital expenditures. Although in some ways negative, imagination, ingenuity, and innovation will create new and we believe better opportunities for investors. As your advisors, we have configured your portfolios to take advantage of the situation that we see looking forward. Thank you very much for listening. We hope you found our presentation to be interesting and informative. And remember, we are never too busy to have a conversation with you about your financial and investment plans. Please don't hesitate to contact us with questions, comments, or suggestions. Thanks again, and please stay safe.